All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. If you've been searching the internet looking for information on investing in real estate using life insurance, you've come to the right place. So go down to the description box right now, like this video, and subscribe to this channel so that you're notified whenever I come out with any new videos. Today, we're going to be talking about how to add more death benefits to your overall policy without sacrificing your focus on cash value. It's important to remember that in a maximum overfunded life insurance policy, the goal is to get as much cash value as you can for the money that you're putting into it. And the way you do that is by solving for the lowest possible death benefit. But what if that's not enough for you? What if you need to have more? So in this video, I'm going to show you one way that I think is the best to most efficiently add death benefit protection to meet your needs while still maintaining your focus on cash value accumulation. So if that sounds interesting, stick around after the intro and we'll get started. Thanks for sticking around. I'm Tom Rutkowski with Innovative Retirement Strategies, and this is my Double Play channel. Today, we're going to be talking about how you can efficiently add more death benefits without losing your focus on cash accumulation, your cash values. I believe that the best way to do that is by adding separate staggered term policies. So the way I'm going to go through this today is to just simply explain why term, why separate term policies, why staggered term life insurance policies. And then I'm just going to go through an example to kind of show you visually how it works and look at some numbers. If you get a chance, definitely check out the How Life Insurance Works video so that you can get a basic understanding of how life insurance works. That'll kind of be a prerequisite for this video. And then also take a look at the minimum versus max funded life insurance so that you understand exactly what we're talking about when I mention a maximum overfunded life insurance policy. All right, so let's get started. Why separate term life insurance instead of just simply increasing the death benefit on a permanent life insurance policy? Well, the key thing to keep in mind is that permanent life insurance is coverage for life. It is much more expensive than term. With term, the insurance company is selling that, understanding that you are probably going to outlive the coverage. You know, whether you have a 10-year term, a 20-year term, or a 30-year term, they are insurance companies and they have actuarial tables and they know just how many people are not going to make it through that 10-year term, and they can plan for that and set aside enough money to cover all the claims that they're going to have to pay and still make a reasonable profit. But when it comes to permanent life insurance, they know that they're going to have to pay a claim someday, and they need to account for that. So basically, the cash value of a permanent life insurance policy is you or the policy owner saving up the death benefit on the life of the insured over the insured's life expectancy. So clearly, much more money needs to be set aside. And typically, the fees are a little bit higher in a permanent life insurance policy to account for the additional underwriting that's required. The second reason why separate term life insurance policies is just that you have an opportunity to shop around. Very rarely when I'm doing business is the best term policy coming from the same company that wrote the permanent policy that I'm putting together for a client. So oftentimes it might be the case that if you have staggered term policies of 10, 20, and 30 years, you might have 3 different companies that have the best rates for each one of those. So there's no reason why you need to go with just one company unless you want everything coming from the same in the same colored envelope, because you're going to get different statements for each one of your policies. So there's really nothing to be gained by just sticking with one. And finally, it allows you to meet your death benefit expectations without buying extra coverage that you don't need. One thing to keep in mind is that in a maximum overfunded life insurance policy, the death benefit is always increasing over time. So since it's increasing, your need for outside death benefit protection decreases. So we'll get more into that in the next section on staggered term, but that's the gist of that. All right, so why staggered term? Using 10, 20, and 30-year terms allow you to keep the overall death benefit at or near your target. And later on in the video, I'll show you an example graphically that it illustrates just how the death benefit increases over time and how the term is used to just fill in the gaps of what's necessary during the time that you need it or want it. And again, I just want to stress that the death benefit of permanent life insurance is always increasing. And as it increases, the need for additional term from outside decreases. And also, all underwriting is done upfront, so nothing can be declined later. All right, so now we're going to look at an example of just a sample client, and this is actually real life. This is from an illustration that I put together for a client just last week. And this is a 40-year-old, preferred non-tobacco. Annual income is about $100,000. And in life insurance, typically the rule of thumb for death benefit protection is about 20 to 30 times what your annual income is. So if you're making $100,000, you want to be able to leave your spouse with enough money that they could literally go out and buy an annuity that could be used to replace your annual income. So in this client's case, $2 million represents 20 times his income. And when I'm doing a maximum overfunded policy based on $2,000 a month or $24,000 a year, I should have put that here, that results in a death benefit of just over $400,000. So again, I'm going to be showing you why I think separate term policies are the best way to provide that $2 million coverage over time while that initial death benefit increases over time. And I'm also going to show you just exactly why a permanent life insurance policy could be used, but why it's more expensive as well. I also want to note that you can account for special risk considerations. The thing I have in mind is mortgage protection and children's college expenses. You want to be able to make sure that if something happens to you, that your children are going to have enough money to get put through college without your ex-wife having to go out and get, work a second job or try to make ends meet, keep the house, and put the kids through college. Use life insurance to take care of that so she doesn't have to worry about that. Secondly is the mortgage protection. When you purchase a house, you've got a big financial obligation and you don't want to lose it. And you certainly don't want your wife to have to move out if something were to happen to you. So make sure that you've got enough death benefit protection again so that she could, if she needed to, either replace your income or just simply pay off the house and not have to worry about that obligation. But that obligation, again, is going to be transitory. That could be a 30-year mortgage. It could be less. You could pay it off early. But again, that risk goes down over time, as does the need for saving for college once the kids have grown up and passed the age of college. So main point here is just that you can account for these things with added term policies that will drop off once the extra need has expired. All right, this graph is showing you the cash value of our maximum overfunded policy that was based on $2,000 a month, $24,000 a year for 10 years. And then we're reducing the death benefit to drive out the cost of insurance. And then with that minimum death benefit, that minimizes the costs, and now the cash value grows forever. So if you look at the blue line on here, if you can pick it apart from the rest of the clutter, you can see that it starts off at just under $500,000. And over the 10 years, it increases to right at the top of that purple line there. And then we're reducing the death benefit, and it's dropping down to about $500,000 again. And then it slowly starts to increase through the next 20 years. Now, if this client's ultimate need is to have $2 million of death benefit protection, we can accomplish that with either a 10 or a 20-year term policy with $260,000 of death benefit. And that's indicated by the purple box down at the bottom. So that increases the death benefit to about $750,000. And then on top of that, we're also stacking a 30-year term policy at $1.3 million. So that gets us from the $700,000 of death benefit up to the $2 million. So just to summarize what we're looking at, the initial death benefit on the policy was just under $500,000. So we'll round it to 500. We're adding about a little over $250,000 of term, 10-year term, gets our death benefit up to $750,000-ish. And then we're also adding $1.3 million of 30-year term to get the death benefit up to $2 million per year. Now, in 10 years, the cash value of the base policy, the blue line, has grown to replace the need for the death benefit that term was providing. However, since we're slashing the death benefit to drive out the cost, there is potentially a need for it to continue through 20 years. So that's why I put down you could have a 10 or a 20-year term, because with that death benefit reduction, you could make a case for having an extra 10 years of coverage to keep that death benefit up. In this case here, the client just opted to have the coverage for the first 10 years, but not the second. And then you can see that anyway, at the end of the 10-year period, the need for that death benefit has gone away. And now the $1.3 million, in addition to the death benefit on the base policy, is still providing close to $2 million worth of coverage for all that time. And the things to point out here are, you can see that we're never really getting much more than $2 million. Even out near 30-year point, the death benefit on the base policy is up to just over $1 million. And we've got $1.3 million on the base policy. So we're just a couple $100,000 more than what's absolutely necessary. Now, there's just the term policies are very lumpy. You have 10, 20, and 30 years that you can play with. So clearly we could undershoot it a little bit, or we could overshoot it a little bit. But clearly the increasing death benefit of the base policy means that you're going to be under or over, at least at some point during the term durations. So hopefully this graph makes sense. It's a little busy. I tried to get a lot on there. I think in all the concept itself is very simple. All right, so this is showing the same information just in tabular form. So I'm just showing you the numbers of where the base policy death benefit is at over time. So year 0 would be at inception, $421,000 of death benefit. Then year 10, 20, and 30. And we're just showing that with the 421 of base policy plus the 260,000 of 10-year term plus the 1.3 million of 30-year term, we're sitting at $2,001,071 of total death benefit protection. At the end of 10 years, between the death benefit on the base policy and the death benefit on the 30-year term, we're still at just over $2 million of total death benefit. Same at the end of 20 years. And finally, at the end of 30 years, the death benefit is going to be at about $1 million. And if I go back to the graph, you see that when that 30-year term policy expires, the death benefit is going to drop back to the $1 million, just over $1 million, and then grow from that point on. So they'll no longer have $2 million of coverage after that point. That's really what you should be making of this year 30 total death benefit. All right, so the next thing I want to look at is, what if we need $2 million worth of death benefit protection for life? So in the previous example, the term expired at the end of year 30, and the death benefit of the permanent policy was only about $1.2 million. So in this case here, I mean, you just can't get a term policy with a duration more than 30 years. So the only way that you can do that is to use a permanent policy to make up the shortfall. So you could do that with either a standalone policy, and you might consider using a hybrid life or long-term care policy, which I like these because the hybrid life and long-term care allows you to get an extra long-term care benefit that you can use while you're alive. So oftentimes there's a multiple here. So if the policy itself has a death benefit of, say, $100,000, it might offer two or even $300,000 of long-term care benefits if you were to not be able to pass one of the six activities of daily living tests. That's getting out of bed, going to the bathroom, feeding yourself, dressing yourself, and so on. The other thing that you could do is to simply increase the death benefit of the permanent policy itself. So on the next page, we're going to look at an example of an illustration with exactly double the death benefit of the example that we looked at earlier and see what that looks like. All right, so here we're looking at the same premium structure. That is, we're paying $24,000 or $2,000 per month for 10 years, and then we're lowering the death benefit. So in that, once we're lowering the death benefit, from that point on, there's no difference between the policy with double the death benefit or the one with the lower death benefit. But if we go across, we can see that the death benefit now is $863,000, which is exactly twice what the death benefit was in the previous example. So, but instead, if we double that and keep the premium the same, we're buying more death benefit, but it's increasing the costs within the policy so that you have less cash value. And that's an important thing to point out because it's not increasing your cost. It's important to remember that in a maximum overfunded life insurance policy, you have way more cash than what's actually necessary to fully fund that life insurance policy. Even a minimally funded even what I consider to be a minimally funded life insurance policy is still adequately funded to meet the death benefit obligations over time. So to the extent that we're putting in 3 times as much premium or 4 times as much premium, there's just that much more cash in the account. So there's plenty of cash there to absorb the death benefit protection that we're buying. So at this point, this policy is not what I would consider a maximum overfunded life insurance policy, but it's certainly not a minimally funded policy either. It's sitting somewhere in the middle, just simply an overfunded life insurance policy. And you may look at that and you may think, okay, these numbers are a little bit lower than the optimized design, but I still have plenty of cash value and I have double the death benefit. This is not a bad thing. And, I want you to remember that. You might find that extra death benefit, is something that you value. But also, again, if that need is transitory, to put kids through college, to pay off a mortgage, then the cheapest way to do it and maintain the maximum cash value is to do separate term policies. But this would certainly work to allow plenty of cash value that you can still leverage for the double play, as well as meet the additional death benefit requirements. But you can see here that after 10 years, when we do that death benefit reduction, that cash value and death benefit drop down to just about the same as the previous example. Because again, we're minimizing the death benefit based on the amount of cash value that we have. So from year 10 onward, both policies are the same. So if you need that death benefit protection all the way out through year 20 and beyond, year 30 and beyond, then you've got to look at funding that policy for even longer. So you don't have to maybe put $24,000 a year into it, but you probably need to put in at least enough to maintain that higher death benefit. So the level at which what I would consider to be a minimally funded life insurance policy or traditionally funded life insurance. All right, so the next thing that's important to realize here is that this policy with double the death benefit is also capable of getting double the premium. So I'm showing it to you with a $24,000 premium, which is making it overfunded, but not maximum overfunded. But it's very important to realize that you could put up to $48,000 into this because we doubled the death benefit. We now doubled the cash value, and we also doubled the amount that we can put into it. So it would behoove you to put in up to $48,000 a year. Now, you may not have the budget for $48,000 today, or this client may not have had the budget for $48,000 today. But that's not to say that a couple of years down the road, after a few pay raises at work or his real estate business takes off, that suddenly he might find himself in a position where he does want to increase the premium beyond the $24,000. And I know many of you are watching these videos and trying to decide whether or not this is something that is actually works. But I just want to tell you, a lot of my clients, a few years down the road come back to me and they want to increase the amount of money that they're putting into these because it's doing exactly what I promised and everything is performing exactly as promised typically. You got to keep in mind that an illustration is not the real world, right? We're using projected rates. So what you see in reality is going to match reality, but it's still, everything is functioning exactly as it's expected to. So the main point I want to make here is just that purchasing that extra death benefit up front gives you the flexibility to increase the amount of premium that you're putting into the policy later. And that flexibility is important, because more than likely, if this works, you're going to want to devote more money to it. All right, just wrapping up. If you need more death benefit protection than what is provided by a maximum overfunded policy designed on the premium that you can afford, then the best way to most cost effectively add that death benefit while maintaining the focus on cash value is to utilize separate staggered term policies. And hopefully this presentation today has shown you that that is in fact the best way to do it. But I also showed you a way that you can get plenty of extra death benefit protection while still getting plenty of cash accumulation, even inside of a permanent policy. The difference being that even though the cash accumulation won't be as good, it does give you the flexibility to add additional premium later. So that's certainly an option that should be considered and you should talk to your agent about. So that's all that I have for you in this video. If you're hungry for more information and you're not ready to talk to a life insurance agent yet, then by all means, go out to Facebook and join my double play group there. There's a link down in the description. That group is just made up of people that are my clients, people that are just doing this, that have no relationship with me, and people that are there to learn. But there's a lot of expertise in the forum, so go ahead and ask questions and hopefully somebody can get back to you with an answer. There is also a written blog post that usually accompanies every one of my videos that I do. So be sure to go out to my website, innovative-retirementstrategies.com, and you can find the blog post that goes along with this. And sometimes there's more information there, and oftentimes there might be a little bit less. It just depends on how the writing flows. But in any case, there's a ton of information on my website that should answer all of your questions. And if your questions aren't answered again, put them in the comments down below, and I'll get back to you as soon as I can. And if you put them in the comments, the other benefit of that is just that other people might have the same question, so they can benefit from seeing the answer. So with that, I will see you in the next video. Thanks.